Hi, and welcome to Trade of the Week. Thursday's $47 fall in gold took many traders, me included, by surprise. This could have been a great trade, so this week I'm having a look at what clues would have helped us to get on board, and how we can spot similar moves in the future. In June, after making a double top at just above 1260, the gold price returned to around 1240, supported by its 21-day moving average. In truth, a short bet on gold looked far too risky. So where were the clues that all was not well with gold? What looked like clear clues, with hindsight, weren't quite so obvious at the time. This was more a case of piecing together several signs to make a bearish picture. Firstly, we could look back at the failure to match the previous week's high. Secondly, some traders appeared more relaxed about sending the price down below the 21-period moving average than before. And thirdly, the parabolic and MACD indicators have both turned bearish. My response at the time was that the price was consolidating before the next push higher, probably to 1300, and that when the price dropped below the trend lines, there were always buyers ready to let snap up any loose bullion. Each day the price continued to close above the trend lines. And, as a reversal sign, I find the parabolic about as trustworthy as a politician's promise. Think about the above signs as amber warning lights that should have caused traders to look a bit more closely at the chart. The red lights came on around about Thursday lunchtime. In this case, I don't think crossing the 21-period moving average on the 30-minute chart was significant, even with an RSI well below 50. The line was too flat and had been crossed repeatedly over the past few days. The same could be said of dropping below the trend line and the 21-day moving average. Each previous break had seen a subsequent reversal. The first real pointer here was that the price had been trading in an ever tighter band, with the Bollinger Bands almost meeting in the middle. This usually precedes a breakout, with the odds favouring a continuation of the trend, in this case upwards. However, a series of signals round about the US Open provided enough clues for a trade just after 3 o'clock. At 2 o'clock the Bollinger Bands were clearly widening. This alone wasn't a signal, as there had been a few false starts during the week. The first strong sign was 3 red candles sliding down the lower Bollinger Band. The Japanese consider 3 to be a lucky number, and although the candles were a bit messy, they reflected an increase in ready sellers. But for me the clincher would have been the 3 o'clock rally that tried to move above the 21-day moving average and failed. A cautious trader would have waited for that candle to close before selling at 12.31. My stop loss would go just above the day's high at 12.46. A trade against the underlying trend is more risky, so I'd want to be out quickly if I was wrong. A £2 bet here would give a risk of £300. In order to justify the trade, the target needed to be 1200 at least, but I'd watch out for signs of support round about the 50-day moving average at 12.22. So what happened? A succession of red candles drove the price down to 12.04 by 5 o'clock, where it paused before crossing through 1200 at just after 7. So, closing out at 1200 would have given 31 points at £10 a shot on a £2 bet for a profit of £620. Like so many books on trading, this was easy to explain in hindsight. The reality was far tougher, partly because there have been several similar moves during the week. A trader might well have suffered several failed bets before landing this winner, but that's the very nature of trading. Have a good weekend.